It's been a mixed day for US economic data today, with the ISM Services PMI coming in slightly higher than expected, while the ADP private sector payrolls report missed expectations earlier, and that caused the US dollar to weaken. But it's coming off its earlier lows now on the back of the ISM PMI data, which came in at 52.6 compared to 52 expected. The ADP report was one of the worst readings since 2023, I think it was. The headline figure of negative 32,000 was way weaker than plus 5k expected, and that caused traders to ramp up their expectations about a Federal Reserve rate cut. Now, the rest of the week only features a handful of economic reports from the US. Jobless claims come in at 1:30 tomorrow. Challenger job cuts is also important, but there's nothing significant to cause the market's pricing of the Fed's rate cut to change materially. The Fed's core PCE price index would have been one, but in recent months the focus has turned away from inflation and more towards employment, and for that reason I don't think this is going to cause a material impact in those expectations. And so there's not much in terms of economic reports left until the Fed's meeting next week. Of course, we have the jobs report and CPI, but they will be released after the FOMC rate decision. So it looks like the market is fully now expecting a rate cut from the Fed, and that's why the US dollar is weakening again. And we've seen that in the euro dollar chart today, which has been pushing above the 116.50 level, which was previously resistance, as you can see on this daily time frame. And if it can now hold above this zone, then the next upside target could be the high from middle of October at around 117.28. Thereafter, 118 is another potential area of resistance or a bullish target. And then from there, it could reach towards the September highs. But for the time being, the key question is, can it now hold above this area of resistance around 116.50? A far more interesting currency pair to watch is the dollar against the Japanese yen, which has been falling of late. And it's all to do with expectations that the Bank of Japan is going to hike interest rates in a couple of weeks' time, whereas the Fed is seen cutting interest rates. So for that reason, the dollar yen has weakened because of the narrowing yield differential between US and Japanese bonds. Keep an eye on the Japanese bond market, because that could trigger all sorts of volatility in other risk assets if the yields continue to press higher. And that could be another reason why the Japanese yen could strengthen against the US dollar even more. And so looking at price action here, we can see that it has broken 156. Yesterday it tried to break back above that level, but it failed, right? Resistance held right where it needed to. And so the downward trend resumes that has been in place since the 20th of November, so not long ago, really. But the key level is the 155 handle, which is a psychologically important and a key support level to watch, given that this area was previously resistance and we broke above it. We retested this level a couple of days ago and held. So for as long as this level holds on a daily closing basis, then one has to be a little bit more cautious in terms of how much downside one can expect from this currency pair. But should the 155 handle break more decisively, so we close below it, that could then pave the way for further technical selling towards 154, possibly this low here at 153.60, and so on. So there's the potential for a big drop here in the dollar yen as the Japanese yen catches up with other foreign currencies which have benefited from a weaker dollar. So far, the dollar yen hasn't materially benefited from a weaker dollar, but could it catch up now with the dollar, with the other currency pairs, is a key question. Now that we are in December, the Santa rally is something that a lot of people look forward to in this month, which is a seasonal trend where equity markets rally into Christmas, hence the name of the rally. So far, Santa hasn't arrived as the index holds around this key area of resistance of 6,830-ish. This is where the index dropped previously. So it will need to clear this area decisively before it could potentially target new highs. But With bond yields in Japan rising, there's a risk that we could see the unwinding of the carry trade, and no one really knows how big that could be. So that's something to keep an eye on in the next couple of days until the FOMC meeting. My guess is that markets will potentially just hang around here, or maybe weaken a little bit heading into the FOMC meeting. But from a technical point of view, we'll just keep an eye on key levels and act accordingly based on what happens. So resistance I've mentioned is here. Support is seen around this area at around 6,766, where we have the 21-day exponential moving average converging with the prior support and resistance level. Below that, I think things will get a little bit more exciting, certainly for the bears, but we could see some volatility creep back into the markets should that area break down decisively. If that level were to give way, then we could well see some downside follow through, possibly down to 6,666. And then below that, there's not much in terms of support until this shaded region that was tested earlier this month, or last month, I should say, at around 6,500 to 6,530. So there is the potential for the S&P to drop if volatility rises because of the rising Japanese bond yields or otherwise. But we'll need to see the breakdown of a few support levels on the S&P 500 before we turn tactically bearish on the market, because for the time being, the trend is clearly still bullish. For more market updates and insights, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.